First of all, thank you, Karen, for the introduction. Thanks for having me today. I do want to make it a conversation, so please, I always ask audiences to show me respect by asking me your toughest question. And I mean that sincerely, because if you're thinking of a tough question, there's a chance somebody else is thinking of the tough question, and I'd rather get it out in the open and have a chance to address it than have you leave having not asked and answered your question. I'm only going to speak for a few minutes up front, and then I'll turn to Karen, we'll have a discussion, and then turn to all of you. Let me just start with level setting. You all, most of you probably know this, but some people may not, on why I'm here. I didn't know a lot about the Federal Reserve before I went to Washington when I was at the Treasury Department. One of the things that's unique about our country is that our central bank is distributed around the country. If you look back in American history, as a country, we hated the idea of having a central bank at all. Alexander Hamilton created the first one. It lasted about 20 years. We didn't like the idea of all this power concentrated in this group in Washington. It just felt un-American. And so we had these fits and starts, and then we had a lot of financial crises in the 1800s, and finally Congress said, we need to do something about this, and they just said, we need a central bank. And so, but the negotiation was, the compromise was, we're going to have a central bank, but it's not going to be all concentrated in one place in Washington, D.C., under the control of the executive branch. So the compromise was, they created a board of governors in Washington, and then they created 12 regional Federal Reserve banks around the country, and those regional bank presidents, myself included, are appointed by local representatives. So there's a board of directors here. It's chaired by a woman named Mai Kao Hong, who runs the Wilder Foundation in St. Paul. Our deputy chair is Ken Powell, the CEO of General Mills, and there's 9 total. And they're the ones who did a search and ended up appointing me. And the point of this is that you get a distributed central bank, you have a diverse set of perspectives, not just representing Washington, not just representing New York. So the reason that's important for you to understand is it's important for me to hear from you so I can get a better sense of what's going on in our region. I travel a lot around our region, which is Minnesota, North and South Dakota, Montana, part of Michigan, part of Wisconsin, to understand what's happening in the local economy, what's happening in the credit market there, and that helps me become smarter when I go back to Washington, D.C. and make our policy recommendations. I'm here to represent you and represent your clients. And so that's why I'm here, and that's why it is very important that I hear directly from you what's on your mind and what you are seeing and experiencing. Now, I've been at the bank for a little over a year. I joined January of last year. One of the first issues I wanted to take on was the issue of too big to fail. So I was, as Karen said, I was one of the first responders to the financial crisis. I saw firsthand how hard it was to arrest the crisis once it was in full bloom. And I feel very strongly we never want to have that happen again as a country. The problem is, if you look at human history, human societies are prone to exuberance, they're prone to overreach, they're prone to crisis. So these things happen every 50 years, every 80 years, every 100 years, and they tend to be different when they happen in the future. But there are echoes, there are some similarities as they happen. And so I, right out of the gate, started with our researchers at the Minneapolis Fed, which has been a long-time leader on the issue of too big to fail, and said, what can we do about this? What analysis can we bring to the table? And so last year we brought the best experts in the world to Minneapolis, hear from them. Some of them said, break up the banks. Some of them said, increase capital for the banks. Some of them said, don't do anything. Dodd-Frank is just fine. It's addressed the problem. Well, we said, let's hear all sides. Let's do our own analysis and put forward our own plan. And in November, we released a draft of that plan, and we've been receiving comments and are preparing to release a final plan. The bottom line is, and I've been saying this to anybody who will listen, is the biggest banks are absolutely still too big to fail. Don't let anybody tell you otherwise. If one of the big banks ran into trouble today, they would be in the Oval Office on their knees begging for a bailout, and the administration would have little choice but to help. Why? Because you all saw what happened when Lehman went into bankruptcy. The chaos it created in the money markets, the chaos it created in the broader banking sector, in the non-banking sector, it almost brought our economy to its knees. Only with massive government intervention, both in the money markets themselves and through the TARP and the Federal Reserve, were we able to stabilize the economy. And so I don't think that's a good situation for us to be in as a country. And so the plan, after all the analysis that we did, the plan that we put forward effectively doubles the capital requirements of the biggest banks. And it forces them to make a tough choice. You can either stay large, that's fine, and you're going to have a lot more capital to protect all of us, or you can choose to restructure yourselves. And if your business model can support that higher capital, that's great. You can choose to make that decision. You decide how to respond to that. But the bottom line is the taxpayers should not be on the hook for the big risks that the biggest banks are taking. And keep in mind, when you and I go to get a home loan, the banks ask us to put 20% down typically. Why do they do that? That 20% is to protect the banks in case you and I screw up and get into financial trouble. Well, it's pretty simple. If we make the biggest banks put 20% down on their investments, then we get protected from their bad investments and their bad bets. Seems pretty fair to me. So our basic plan, and there's a lot of detail, there's 50 pages of detail on our website you can look at. Our basic plan is substantially higher capital requirements on the biggest banks, those $250 billion in assets and above. And then with that, we can relax regulations on the small banks that are not systemically risky. Because I know you hear from a lot of small banks, I do, how they're getting smothered by the same regulatory net that's trying to address too big to fail. Well, the truth is little community banks are not systemically risky for the economy. They do have a very important role to play in providing credit to our communities, and they should not be captured in the same regulatory net. So that was a big initiative for us, and I'm proud of the work that we've done. And again, happy to take your feedback. I'll say this, we put this out, we sought comments from experts. To be blunt, nobody's been able to poke holes in our analysis. Our analysis is spot on, and I'm very proud of that. And it's based on analysis that the IMF has done, looking at the history of financial crises around the world and figuring out how do we best learn from that, how do we best have a regulatory system that can protect us from that, and how do we do it in a way that society is better off. So that's number one. Number two, in a very different way, one of the things that surprised me about our region, this is a really remarkable local economy. It's very diverse. We have financial services, we have manufacturing, we have ag, we have mining, we have healthcare, et cetera. It's a diverse economy that's doing quite well overall, and we have overall low unemployment. But we have huge gaps in our society here, all around the country, but also here. And that surprised me, the extent of the racial and economic disparity in our region. And I wanted to understand why that is. And so I started talking to economists at the Minneapolis Fed and around the country, and I was amazed at how little we understand what the source is of those gaps. I'll give you just a data point. In America, nationwide, black unemployment is almost always twice white unemployment. If it's a booming economy and white unemployment is 4, there's a really good bet that black unemployment is going to be 8. If it's a recession and white unemployment is 7, pretty good bet black unemployment is going to be 14. And even if you adjust for education, so it's college graduates versus college graduates, same ratio, same disparity. Or non-high school graduate versus non-high school graduate, same disparities. So I started asking the basic questions. Why is that? What are the structural factors? Now we know as the nation's central bank, we can't tailor monetary policy to individual communities or segments or groups. It's a blunt tool for the whole country. But my view is if we can do the research to understand these problems and put forward ideas that other policymakers, whether it's the executive branch or Congress, could then take and implement and do something with, then that's an appropriate role for us to play. So in January of this year, a few months ago, we announced what we're calling the Opportunity and Inclusive Growth Institute, which is a research institute focused on understanding economic and racial disparities. And it's not just about race, it's also about rural communities and the gaps between rural America and the cities that are generally doing better, understanding what can be done, whether it's education or housing, et cetera. And so we're just getting started. In May, we're having our first conference. We've recruited the best academics in the country who are working on these issues to advise us as our board of advisors. We have visiting scholars who are going to be coming from around the country to Minneapolis to work with us to understand these issues and see what role the Federal Reserve can play in analyzing them and putting forward solutions. This is a long-term research initiative. It's going to take years. I mean, honestly, these problems are decades or more in the making. We're not going to come up with answers overnight, but we're going to do our part, and we're going to get going. And so that's another big initiative. And the thread that is woven underneath all of this is I want us to take on the biggest economic challenges that we face as a nation, period. I believe the Federal Reserve banks, there are 12 of them, should be research centers taking on these big long-term issues. If we're not going to do it, who's going to do it? I mean, you're watching Washington like I am. Washington, by its nature, being a political city, is much more, has to be focused on short-term issues, short-term challenges. Somebody needs to be doing the long-term economic research and thinking on these big challenges, and I want us to play that role in partnership with others. And so that's what we're going to do. And so with that, I can sit down next to you, Karen, if
Sure.
whatever makes it easier for people to see us. Or maybe we can both stand here so people can see us. And take your questions, and then we'll turn it over to the audience.
All right.
Thank you.
Well, you've made several comments about the structure of the Fed and its decentralized structure, and there have been numerous proposals saying that it doesn't work anymore. What do you say to those? Any merit?
You know, it's nobody would, if you started from a clean sheet of paper today, nobody would design it exactly the way it is today. I'll give you an example. So the Minneapolis Fed, we're here in Minnesota. We have a fairly small population. The San Francisco Fed has 60 million people in their western region of the country. Now, 100 years ago, these diagrams, the way the districts were designed, made sense. Missouri has 2 Federal Reserve banks, St. Louis and Kansas City. That was a compromise to buy off some very powerful senator who was negotiating the bill. So if you started with a clean sheet of paper, you wouldn't design it this way. Having said that, it works. And we found a way over decades to get the system to work. And so I think we need to be more transparent in how we're making decisions. I think we need to be engaged with the public more transparent, getting more feedback so that people have confidence in the way we're approaching our decisions. So I'm doing everything I can to try to innovate in how we reach out to people, whether it's doing a lot of Q&A like this. By the way, the reason we're live streaming this is I want as many people who want to know what I'm talking about, what I'm doing, I want them to be able to do that. So I live stream all of my events. I'm on Twitter. I do Twitter Q&A with people to engage with people from the public. I'm looking for every way I can to try to demystify the Fed. And I think if people saw what we're really doing, people would have a lot of confidence in the current structure. So I don't think we need a big change in the structure. I do think we need to communicate more freely than we have been historically.
You've seen many aspects of government. You're a Treasury. You ran for governor in the state of California. Anything surprise you about the Fed? Anything you didn't expect?
I knew the Fed from when I was at Treasury, because we worked very closely together, had very smart people, very high quality, dedicated to public service. And that's absolutely true. If you got to know our colleagues here in Minnesota and around the country at the Minneapolis Fed and elsewhere, you'd be very proud of them and proud that our nation attracts people who have this commitment to public service. So that didn't surprise me. I knew that. One thing that did surprise me is I talked about some of the disparities and the racial gaps in our region. We have those in the Fed too. We don't have enough diversity in the Fed itself, and it's something that we are working hard to try to improve. So if you look at the FOMC, currently I'm the only non-white person on the FOMC. The new Atlanta Fed just selected a new president, an economist named Raphael Bostic. He'll be the first African-American Federal Reserve Bank president in the history of the country. It's amazing. It took 103 years for one of the 12 presidents to become African-American. And so we need more diversity at the Fed, at the staff level and at the senior levels. It's something the whole system is committed to. I was surprised to the extent of that before I got in and saw it for myself.
You talked about the plan and too big to fail, and you referenced 2 pieces of it, I think, and I believe it's a 4-step plan. The first step was the capitalization of the very biggest banks. How are you defining the big banks?
So $250 billion assets and above.
So why that benchmark?
That's admittedly it's somewhat arbitrary. Whenever you make policy, you have to pick some boundaries, and it just, based on our analysis and looking at different literature reviews, it seemed like that was a reasonable way to capture the biggest banks. And the truth is, the idea of systemic risk, there is judgment involved. I wish it was a simple formula that we could perfectly define, and it is contextual. So I'll give you an example. If Bear Stearns was saved in a weekend in March 2008, when the financial system was in a very perilous state. If Bear Stearns had run into trouble 3 years earlier and the economy was very strong and all the other banks were fine, it probably would have been okay to just let Bear Stearns go into bankruptcy. So the definition of what is systemic depends on what else is happening in the rest of the economy. And so we just looked at the biggest institutions in America and said, we have to draw a line somewhere. This seemed like a conservative place to draw the line that is erred on the side of protecting taxpayers rather than protecting shareholders.
Second part of your plan gets at the systemic risk, and you've designated the Secretary of the Treasury to have a pretty significant role. Why did you put that huge obligation with the Secretary of the Treasury?
So what we say in the plan is for these biggest banks, it's about a dozen of them, first thing you do is you take up their capital levels to roughly double where they are today. And then the Treasury Secretary must certify affirmatively that these banks are no longer too big to fail. Now imagine you're the Treasury Secretary. You're not going to want to make that certification. Because if you certify that this bank is no longer too big to fail and it runs into trouble and it needs a bailout, you have some big time egg on your face. So we wanted to put the Treasury Secretary in a bind, to make the Treasury Secretary really reluctant to make that certification. And he or she will only make that certification if they are really confident that this bank is no longer too big to fail. And if they refuse to make that certification, the capital levels start cranking up even higher. And this will put, again, the whole idea is we want somebody on the hook to make this call, and if they don't make the call because they're not sure taxpayers are protected, the banks are going to see even higher capital levels, which is going to create huge incentives for the banks to restructure themselves. So here's the thing. The banks love to tell you and me and brag about their great economies of scale that we all benefit from as society. Well, if the banks actually have this great economies of scale that we all benefit from, they can afford higher capital. If they cannot afford higher capital, then these economies of scale are a myth. And all they're doing is their business model depends on taxpayer subsidies, in a sense. So we're putting that to the test by ratcheting up capital requirements automatically absent the certification.
But if you ratchet up capital, won't people put their money elsewhere? What's going to stop investors from not putting money in other industries? And will we have management talent also leave the federal or the financial services industry?
Well, I mean, what would you expect to have happen? So we jack up the capital requirements on the biggest 12 banks in America. What's going to happen? One is those banks may choose to restructure themselves, which I would not be opposed to. Two, the activity and the talent may move to community banks or regional banks. We won't have as concentrated a banking sector as we have today. We'll have a more competitive banking market, which I also think is good for the economy. I also think is good for financial stability to having more diversity and more competition and smaller banks playing a bigger role. So I think that's a good thing. The bigger risk that we're worried about is activity moving from the biggest banks, let's say JP Morgan or Goldman Sachs, to hedge funds. And if it all moves from JP Morgan to Citadel or Bridgewater, these really big hedge funds, have we really accomplished anything? Or have we just moved the risk from one place to another? And that's why in step 3 of the plan, we apply a tax on the debt of the biggest shadow banks. So if you're a little shadow bank, a little hedge fund, you don't pay any tax. Or if you're a big hedge fund and you don't have any debt, you don't pay any tax. But if you're a big hedge fund, $50 billion and above, that's debt financing your investments, then that could be a systemic risk in the future. And we want to level the playing field so that the cost of funding of the highly capitalized banks and these big shadow banks is level. So there's no incentive to migrate the activity to just some other unregulated part of the market. And this, we think, is a real innovation. Nobody else had put forward a way to deal with the shadow banks, and we do. And so we do think that that's important.
Now, you've talked about big banks and community banks. What about the middle?
In the middle, we are leaving them alone, basically saying we're not calling for any change to the current regulations that they're undergoing. We're not increasing their capital requirements. I will say this, if we have confidence that the biggest banks are all highly capitalized, then the system as a whole is much more resilient than it is today. And then we could look at all sorts of regulations and saying, do you need these other regulations on whether it's community banks or mid-sized banks? Do you need to have them as onerous as perhaps they are today? You know, and having the biggest banks with substantially higher capital requirements, it's like vaccinating them, right? You vaccinate the herd, and then any one of them can't bring down the whole herd because the whole herd has been vaccinated. And that's why it's so important that the biggest banks all have higher capital.
One thing I liked about in reading your plan is you addressed supervision and regulation. In my experience, people tend to talk about regulation and forget about the supervision part, which to me is an important and very distinct from regulation, particularly in this environment where on-site exams, informal rulemaking, policy statements, I would argue probably affect the banking industry maybe more than some of the statutes and rules. So what do you envision in terms of that supervision of the community banks versus the mid-size versus the big? Will the exam process stay the same? Would you allow this informal rulemaking to continue? Do we need to redo that part of the equation?
Yeah, I think on both sides, supervision and regulation for community banks, we need to take a fresh look and get it right. And again, I just talked to a lot of community banks, but some of the things that they're asking about, but just to be candid, are not things that maybe the Fed or the OCC directly affects. It may be things that it's the CFPB. And so I think we need to take a comprehensive view on what we're putting community banks through. I wrote an op-ed in the Wall Street Journal a few months ago about my own experience getting a home loan in Minnesota, which was brutal. I mean, I couldn't believe how painful the process was in terms of the documentation requirements. I thought that they had figured out who I was and they were punking me by just continuing to ask me more and more and more things.
Maybe they were.
Maybe they were. And so it was just, and I actually felt bad for it because the banker that I was dealing with, the mortgage lender, would call me and apologize that underwriting was asking for this additional documents. He's like, I know this is ridiculous, but there's no negotiating with the underwriting department. It was ridiculous. I mean, I felt bad for them because it felt like a climate of fear, like just they're terrified of making a mistake. I finally got the loan approved and I bought my house, but it was still a very, very painful process. So I do think that we do need to take a step back and look at what we're doing. Doesn't make sense. Rationalize these things, especially for community banks, which are not systemically risky for the economy, and because they are uniquely positioned to provide credit, especially in small communities in America. It's very hard for the Bank of Americas and Citibanks and JP Morgans to know what's happening in rural communities across our region. That's the role that community banks have to play. And so I do think we have to take a fresh look. But I also know when I meet with members of the House and Senate a lot when I'm in Washington, while there seems to be bipartisan consensus on wanting to relax regulations on community banks, they're nervous that that might be a Trojan horse for relaxing regulations on the biggest banks. And that's why these two issues have become linked. And so it's so important that we really address too big to fail for the biggest banks so that we can then decouple regulation and supervision of the community banks.
You talked about the process of going through your home loan, so that touches on, consumer regulation and protection. How do we balance that consumer protection and safety and soundness? And is your sense it's out of balance right now?
Well, I think if you look at loans are being made, business loans are being made. If you look at surveys of small businesses, they're generally able to get access to credit. It's just a very painful process, as I experienced. I got my loan. I was pre-qualified for it. I got an attractive rate. It was just an extremely painful process. So you have to really want it if you want to go through the process. People with bad credit, it's much harder to get credit today. And I'm not sure, so that's unfortunate, but I'm not sure that that's necessarily a bad, like we don't want banks making loans that they're really nervous about, right? We don't want to force them to make loans to people who maybe there's not a high probability of them paying it back. And so helping people have better credit is a separate policy problem than whether or not banks are making loans. So I don't know, did I answer your question?
Mm-hmm. Which leads to another interesting aspect of what's going on. Increasingly, banks are being looked to as the solution to some of those policy issues, be it redlining, jobs, terrorism. Should banks be used in that fashion?
Well, I think banks, we need to make sure banks are treating their customers fairly. We need to make sure that the Wells Fargo account scandal is pretty shocking to anybody who's looked at it. So making sure that banks are treating their customers appropriately and fairly is important, whether it's a big bank or a little bank. Making sure banks are not turning a blind eye to potential money laundering or financing of fraudulent activities or terrorist activities is also, it's important that they abide by the rules and take that very seriously. And I know the regulators are focused on that, appropriately so. But we can't expect banks are not there to solve all of society's problems. As I said, if we have Americans who are struggling with bad credit, that's not the bank's fault, right? Those are issues about education, financial literacy, the job market more broadly, other things that affect poverty, affect families' lives, etc. We can't expect the banks to solve all of that. But we can expect the banks to do their part, which is treating all their customers fairly, being honest with them, and following the rules and following the law.
One of the comments often made about your proposal is it puts the American banks at a disadvantage with their global competitors. Do you want to address that topic?
Sure. You know, it's true. The fact is, if you go to Europe today, they don't really care about too big to fail. Europe basically says we have these national champion banks, and it's their pride and joy. And if every 20 years or 30 years they have to bail them out, that's okay. We have national champions, and we're happy about that. That's a silly policy position, I think. I don't think it's one that we as Americans should have. And if we can show the world that we can have large banks that are well capitalized, that are not exposing our taxpayers to unnecessary risk, then maybe we can lead the world and show the rest of the world that there's a way that they can have similar in their countries. But I don't think we should wait just because Europe wants to bail out their banks every 20 or 30 years. I don't think that means we should follow their path. And by the way, I'd also say, if any of these European banks that are undercapitalized want to do business in America, we should subject them to the exact same rules that we subject our banks to. And that's how we can start to level the playing field.
Your paper spends a lot of time on the cost-benefit analysis. And my understanding is there would actually be a drag on the economy putting in these high capital levels for the longer-term good. My experience is we live day-to-day, quarter-to-quarter. I mean, you look at what shareholders expect of publicly traded banks. For example, what have you done for me today? How are you ever going to convince citizens, Congress, to take and put something in place that's going to deal with something 50 years from now, maybe, that hurts us now?
Well, we do it, and so the analysis is this. When you raise capital requirements, there are some economists who say there's no harm to the economy. It doesn't affect credit availability. I don't believe that. I believe there is some cost to it. It does raise the cost of borrowing a little bit for those banks' borrowers. Now, remember, we're raising capital requirements on the dozen or so biggest banks in America, none of the rest. So what will end up happening is some of the activity is going to move to smaller institutions, again, which is good from a financial stability perspective. But let's admit there is some cost. Safety isn't free, right? This is just like physical safety. So after 9/11, we as a country imposed many new requirements to improve our physical security. We hired more police officers, hired Homeland Security officers, more metal detectors at airports. Physical safety isn't free. There's a cost-benefit analysis. We avoid potential terrorist attacks, but we pay for it in some inconvenience and some more taxes that we spend. So we as a country have to decide how much financial safety we want. Financial safety isn't free. So we've done the analysis and said, if we raise the cost of credit a little bit for the customers of these biggest banks, but we avoid these terrible financial crises that we have, whether it's the Great Depression or now that we had in the financial crisis in 2008, there's a benefit. And so do the costs exceed the benefits? No. The benefits exceed the costs. So over time, society is better off. One more analogy is nuclear power. A big bank is like a nuclear reactor, right? If it melts down, if it makes a mistake and fails, it's devastating for society. So what happens if there's a nuclear power meltdown? Government will spend whatever it takes to stabilize that reactor because the costs of that meltdown are catastrophic for society. So we could either ban nuclear power, or what have we done? We regulate it so tightly that it virtually can't fail. You can never say never, but it virtually can't fail. That's the same way I think we should treat the biggest banks in America, which is you can choose to stay large, but we're going to regulate you so that society is protected. And those regulations of nuclear power does increase the cost of power a little bit for all of us. But that's a choice that we've made. And so I feel like what we're doing is we're presenting you and the American people some options, some costs and some benefits, and then the public can decide how much safety you want in our financial system.
Now, to accomplish your plan, do you need legislation? Can this be done only through new regulation? And how do we get there?
Yeah, we would need legislation, especially for things like the tax on shadow banks, et cetera. And I do think at the end of the day, this decision about safety versus costs is ultimately a political decision. And I don't mean partisan politics. I mean the American people expressing a view through their elected representatives. I do think that Congress is the right body to make this type of a decision. And, we just got to keep educating people. And the biggest concern that I have is we as a society tend to forget the lessons that we just recently learned. We just recently went through this terrible crisis, and now the winds are blowing. Maybe we should deregulate, as though, it can't happen again. And so it's not that you and I are not going to make the same mistake. It's the next generation and the generation after that, after we're all retired or beyond, that are going to make that mistake. And so the question is, can we put in place a regulatory system today that can stand the test of time, so that when we've forgotten and now this time is different, it can't happen again, the regulations are there to protect us from ourselves?
A number of proposals, and in particular one from Honig has focused on Glass-Steagall. What are your views on Glass-Steagall? Do we put it back in place, tweak it?
Yeah, Glass-Steagall, in my view, I'm not opposed to a reintroduction of Glass-Steagall, but I don't think it would address the too big to fail issue by itself. If you look at the last crisis, just as an example, there were pure play investment banks that got into trouble, like Lehman or Bear Stearns, and there were pure play commercial banks that got into trouble. It wasn't simply the merging of the two of those activities. And so I'm not opposed to it, but again, I don't think it would solve the problem. All the analysis that I've seen, or most of it, suggests that substantially higher capital requirements are the best way to address this. And even Tom Honig, parts of his proposal also call for much higher capital requirements, focusing on a leverage ratio.
Mm-hmm. With respect to the supervision of banks, we were talking earlier today about how the way supervision is conducted seems to have evolved. Back in 1985, some of us were thinking back to those years, there were no such things as enforcement actions. And now you open the newspaper and, I think the top 5 headlines in American Banker are which banks have gotten the penalty of the day. What do you think about that system? Is it good for society to set rules through enforcement actions? How has this affected that relationship between the industry and the bank regulators? Any comment on that?
Well, I can't imagine it's pleasant to receive an enforcement action, but enforcement actions, in my experience, come after a lot of dialogue and saying, you need to address this, you need to address this. You need to address this, and then they don't address it, and then guess what? You're going to get an enforcement action. Mm-hmm. And so there needs to be some form of follow-up. It's funny, I meet with banks and they say, it's so arbitrary why we got this enforcement action. We've been complying with everything. Then I meet with the examiners and I meet with supervision and I meet with folks in Washington. They say, that's ridiculous. These are the 5 things we asked them to do. We asked them a year ago. They said, yes, we got it. A year later, they hadn't done any of them. Then we went back and we said, we really meant it. You need to do these 5 things. Yeah, we got it. We're on it. We're doing it. And they didn't do it. Guess what? You're going to get an enforcement action. So there needs to be some teeth. You need to follow the rules.
Switching topics. Not because I didn't like the answer. You made headlines recently for your dissenting vote. You want to talk a little bit about the FOMC, why you dissented, and what happens behind these doors?
Sure. So in March, the FOMC meeting, the FOMC to raise interest rates by 25 basis points, and I was the lone voter to dissent, saying no, we should hold rates steady. And in January, I published an article looking at exactly the data that I look at on inflation, on the job market, to reach my decision on where the appropriate level of interest rates is. So if you're really interested in this topic, there's a lot of detail on our website that I would point you to. I'll just give you the high level right here. So Congress has given the Fed what we call a dual mandate, which is stable prices, which means what we define as 2% inflation, and maximum employment, as many Americans working who want to work as possible. So we look at data on both of those to see, are we achieving our dual mandate? And if you look over the last 5 or 6 years, we keep getting it wrong. For 5 or 6 years in a row, we keep expecting inflation is going to rebound right around the corner, and we keep thinking, oh, the job market is as strong as it's going to get. Well, it turns out inflation has been coming in under our target consistently for the past several years, and the job market keeps exceeding our expectations. We keep thinking that we're at maximum employment, and then all these Americans re-enter the labor force, which is a really good thing, and turns out we're not yet at maximum employment, so we would have declared victory too soon. So I voted no because in both of those measurements, we're not there yet. Just this morning, our measure, the most important measure we look at for inflation, called PCE, or personal consumption expenditures, came out, and core inflation, which strips out energy and food, which are really, really volatile, core inflation ticked up ever so slightly, maybe from 1.7 to 1.8, but it's more rounding than anything. So we're still coming up a little short on our inflation target, and we're not coming up quickly at all. And the job market keeps surprising us. One of the data points that we look at is called labor force participation. How many Americans are in the labor force? And it fell dramatically after the financial crisis. Now, a lot of people said, well, that's because of demographics. Our society is aging, more people are retiring. But even if you strip out retirees and you just look at working age Americans, there's still some room to come back to what we used to consider normal in terms of how many working age adults are actually working. So because we're coming up short on both of our measurements, I said there's no reason to hurry up and raise rates. Let's let inflation keep climbing back to target, and let's see how the job market, if it can keep strengthening and bringing workers back in, that's a good thing. And so I don't think there's a huge disagreement between me and my colleagues. We're looking at the same data. I just see the balance of risks a little differently than they do.
Could you comment on the Fed's balance sheet?
Sure. This is a topic of great interest these days. We have about a $4.5 trillion balance sheet as a result of the quantitative easing programs that the Fed launched after the financial crisis. And the reason this is, let me just back up for a second. The reason the Fed launched QE is because interest rates fell. Right? So what are interest rates? Interest rates are where savings and investment are meant to balance. They clear the market. Interest rates fell down to zero because of the Great Recession and the financial crisis and the slow recovery. But if you look at the economic fundamentals, the economy as a whole was actually calling for deeply negative interest rates to clear the market of savings and investment. But the Fed couldn't do that. They were stuck at zero. So either they were out of ammunition or they said we need another tool to provide monetary stimulus to the economy because we can't go deeply negative. So they said, well, we're going to buy up long-term bonds to try to drive down long-term interest rates, which will have a similar effect as reducing interest rates. So that's why the Fed ballooned its balance sheet. Now that the economy is getting stronger and we're starting to raise interest rates, there is interest among FOMC members to start to shrink that balance sheet in a gradual and predictable way. And so what I've said is I would like us to announce our detailed plan for exactly how we're going to do that so the markets can see it, can understand it, we can see the market's reaction to it and give the markets as much advance warning as possible. Then we start that process, and then we can go on with interest rate increases when the data call for it.
I gather from your comment you would support greater transparency in terms of Fed decision making?
Yeah, I think so, and different transparency. So one thing that's different about me and my colleagues is I never make, I don't think I do, ever make predictions about when the next rate hike is going to be or how many we're going to have this year or next year. The reason is we're usually wrong. And people get really upset when we say, oh, it's going to be 3 hikes this year. Trust, it's going to be 3 hikes. And then it ends up being 1. Or it's going to be 4 hikes and it ends up being 1. And so I just think it adds a lot of noise and confusion when you have all these Fed heads offering these predictions about how many hikes there are going to be. So I think it's much better to say, I don't know how many hikes there are going to be. Here's the data I'm going to look at in reaching my decisions. I'll be very transparent in terms of what data I look at. You can look at the same data I do. You can look at it in the same real time that I do. And you can use your own judgment. And so I try to err on the side of giving you more information about what data I think is most important rather than making predictions, which I think just leads to confusion. And so I would encourage us to have a different type of communication rather than more of the same communication.
Well, I think it's time now to open it up to the audience and the really hard questions.
Good.
I think we have 2 mics, and because this is being broadcast, please ask your question into the mic. And I guess stand up if you want to ask a question, and the person with the mic will find you. So with that, do we have our first question?
A bunch of shy lawyers? I don't believe it.
I warned you.
I'll do one. Your proposal to double the capital obviously has a number of industry people who think it's not a good idea. But I haven't seen a lot of support from your fellow bank presidents. Why, and without that support, does it really go anywhere?
Well, some of them, I'll let them speak for themselves. Some of them have expressed some support on the idea of more capital for less. You know, if you really increase the capital requirements, you could relax some of the other rules. And I think that there's more support for that than maybe you realize. You know, we'll see. I feel like my job is to identify risks, call them out, being as transparent as I can, and offer potential solutions. And then it's up to regulators and ultimately up to Congress to decide what to do with that. And so we're going to keep pushing. You know, I meet with, as I mentioned, senators and representatives of both sides of the aisle, and there's a lot of agreement that we need to address the too big to fail issue. And there's a lot of agreement that we need to relax regulations on community banks. And so this is one of those issues where I actually think something could get done in Washington. We'll see. But I don't feel like just because it's hard means I shouldn't take it on.
Karen asked you a question about transparency. So from the standpoint of an ignorant observer who reads the newspaper, it seems like there's been this evolving trend toward greater transparency over the years at the Fed. So things that used to be a black box, policy decisions and the like, are now talked about, as you mentioned, you know, with fairly divergent approaches. Is that the new normal? Is that intentional? Has it just happened over time?
No, it is intentional. So the Fed's posture really in the Greenspan era was we're like the Wizard of Oz, right? We're so mysterious, don't even ask, because you couldn't understand, and we wouldn't tell you anyway. And that didn't serve us well, because when the financial crisis hit, all of a sudden we needed the American people to trust us. And we had not earned that trust, because we had not built that trust over time. And so we're still paying the price for that lack of transparency. So all of us are trying in our own ways to be more transparent, to earn the trust of the public that we need in order to do our jobs. And so, yeah, I think that is, it's intentional. You know, for example, in the 80s, the Fed never even put out a statement when they made a monetary policy decision. They just figured the markets would figure it out depending on what's happening in interest rates. Now we put out statements after every meeting. Now, 4 times a year, the chair does a press conference, et cetera. So starting with the chair, first Chair Bernanke and now Chair Yellen, they've really dialed up transparency and communications, and all Fed principals are trying. Sir, there's a question there. Yes. Microphone's coming to you.
I have a question. What did you do up to this time to cut possibility of stealing money of small organizations by some individuals? For instance, secretary-treasurer of some organizations can take all money of their organization and move to another account, and nobody has access to them. An organization comes to a sort of dying situation because cannot pay their financial obligations. So did you do something, not you, your organization did something to preclude, to stop such situation?
So let me make sure I understand. So let's say you have an institution of some kind, and you have a financial professional who could steal from that institution by routing the money somewhere where nobody else knows where it has gone. Is that right?
Yeah, nobody knows because he will not tell.
Well, so I think I mean, now you're getting into things like audits and financial controls and the ability, does that institution have appropriate financial controls? So I think the Fed's role is, as we're supervising banks, we're also talking to the auditors, we're also looking at the financial controls to make sure that the appropriate financial controls are in place. But you're right, it is very hard to prevent one sole bad actor from doing something bad in their own institution. And it's, as you've indicated, in that institution's interest to put the appropriate controls in place. So I think that our job would be talking to the auditors, looking at the financial controls ourselves, making sure they're following rules and regulations. But at the end of the day, it is also going to be up to management to make sure that they've put in place appropriate controls in their own organization. I think it's very hard for us to know that.
No, I don't believe that is very hard. I'm sorry because I contradict you. You
That's
should
okay.
impose on all banks, all tellers, understand, to accept money to be deposited, but to not be withdrawn from account, except with signature of secretary treasurer and somebody from board, or two people from board. Understand? And then chances to be stolen will be much less, understand? But at this time, for instance, secretary treasurer can go and take money, at least in some organization I see, and took them and put in another account at another bank. An organization can do nothing.
All right, but you're speaking, I'm not disagreeing with you, you're speaking to the
It's a
core
simple
financial controls
formality.
that an organization would have, right?
What?
You're speaking about the core financial controls and the rules within that organization of who's authorized to transfer money.
Yes.
I understand, and so I'm with you. I'm not disagreeing with you. So I guess I'm in agreement with you.
Yeah, should be 1-2 person from the board or president, plus secretary treasurer. Secretary treasurer should do simply bureaucratic work, not to take decision what to be done with money. Such decision should be taken by executive committee or by president plus somebody from the board, from executive committee. Yeah. So I don't know. At this time, did you implement it in banks obligations for financial withdrawal, financial payments?
But again, it's going to
To
depend on
have
the bank.
2-3
So
signature from the organizations.
some
from the-
large institutions will have a higher threshold than smaller
Yeah,
institutions.
They have, yeah.
And so we do talk to banks and look at what financial controls they have in place and try to assess. If you have specific instances where you think that that's not being done appropriately, let's chat afterwards, and I want to get to the bottom of the risk that
Okay.
you're talking about.
Okay,
Thank you.
thank you.
Other questions?
Let me ask you a question about the political scene. I heard Barney Frank on radio the other day quite passionately saying that Dodd-Frank had gone too far in creating handicaps for small community banks and that it ought to be changed. And he was asked, do some of your former colleagues agree with you? And his response was, yes, he said, I think the majority of them do. But nothing really has happened in that regard. Do you have a thought about that?
Yeah, I think it hasn't happened. I agree with him that there is a lot of consensus on that point. But I think it's being wrapped up in the big bank issue, is my read of the political situation. That people who do want to relax on small banks are nervous that it's actually going to be relaxed on the biggest banks. And that's why these two issues have gotten conflated. And that's why in our plan that we've put forward, we said, here's what we're going to do to the biggest banks. And once people have real confidence that the biggest banks are safe and sound, that's going to make it easier to then do what I believe both sides of the aisle want to do and relax regulations on community banks. That's why I think personally, that's why I think there hasn't been much movement. Over there.
Could you comment on the impact of rising rates on the federal deficit and what that's going to do to the challenges that Congress has got in trying to solve the budget problems?
Sure. I think you spelled it out right there. As rates go up, there are going to be impacts on not just the private economy, but the federal deficit as well. To be candid with you, that's not what factors into our interest rate decisions. Our interest rate decisions are based purely on what's happening in the U.S. economy, what's happening in terms of inflation and our dual mandate, what's happening in terms of the job market, and what's the optimal interest rate for achieving our dual mandate over time. And, we think that other policymakers are paying attention to what we're doing, and hopefully it'll factor into their thinking. And let's talk about fiscal more broadly. Depending on what Congress decides to do in terms of taxes, in terms of health care, in terms of trade, that also factors into our own analysis of what the outlook is for the U.S. economy. So these things are definitely interrelated, but the mandate that we've been given is look at the U.S. economy, look at your dual mandate, set interest rates based on that, not based on making it easier or more difficult for Treasury to fund their spending. That's up to them.
The Minneapolis Fed has been regarded for decades for the research that they produce, and somewhat cutting edge, particularly related to public stadium funding and early education done by your predecessors. What lessons do you think can be learned, given that the Twin Cities region is kind of a hallmark of taking an opposite approach to that public stadium funding? What lessons can be learned in getting your initiative marketed out in front of people in a different way?
Can you repeat what you just said about the hallmark?
Well, between the stadiums in St. Paul and Minneapolis over the last couple of years, the growing trend around the country of NFL stadiums now saying everybody who's got one everybody who wanted one has one, and public funding was some factor involved in most of those.
So that's not an example of success on our part, right? I want to be clear that you weren't saying that was. Yeah. Well. There are lessons, though, nonetheless. So we may not have won. So first of all, this idea of the NFL has a great racket, right? And they restrict the number of teams, so that there's over demand for teams, and then they get the cities to bid against each other, and they extract those rents for the NFL's benefit. It's a great racket if you're an NFL owner, but the taxpayers pay, and so that's a problem. And the only way to solve that, I think, would require federal legislation to prohibit this, because each state is operating in its own, what it thinks is its own self-interest, but the NFL owners are the ones who really benefit from it. So we failed in delivering that message. However, the Minneapolis Fed and some of my predecessors, a guy named Art Rolnick, who is our research director and a researcher who's currently at our bank, Rob Grunwald, have been working on the issue of early childhood education for years. And it's an important lesson to the gentleman's question about, how likely is this to happen in terms of too big to fail. So what I've taken away from them is they pounded this drum on early childhood education and the research behind it, showing that, why we got into early childhood education? Because the economists at the bank said public money for stadiums is stupid. And someone said, okay, smarty pants, well, what should we be investing in if that's stupid? And they said, okay, we'll go think about it. And the highest ROI they could find was public taxpayer dollars investing in early childhood education in terms of payback for the taxpayers. That's how they came on that issue. So the lesson, though, is they've been pounding this drum over and over and over again, and eventually people paid attention. And eventually the stuff is actually getting implemented. And so while we may not have been successful in convincing people not to spend public money on stadiums, they've been pretty darn successful in getting people to realize early childhood education is a good investment for the taxpayers. And so the lesson for us as it relates to too big to fail is don't give up easily. People say, well, it seems like nothing changes. Well, nothing changes until everything changes. I take a political lesson from the country's views on gay marriage. So in California, I came here from California in 2008, not that long ago. The state of California, which views itself as the most progressive state in the world, the state of California voted to ban gay marriage in 2008. But the activists stayed on it, stayed on it, stayed on it, stayed on it, stayed on it. Now basically the laws of the land have changed not very long later. And so it seems like nothing changes until people wake up and then everything changes. And so I feel like on the issue of too big to fail, we have an obligation to keep speaking up. And then people may not agree with us, but if we keep speaking up, maybe they will agree with us. Are we good?
Any final comments?
No, well, thanks for inviting me today. Thanks for the discussion, and I really enjoyed it. So thank you. Thanks, Karen.
Thank you. Thank you very much.